Rezolve AI stock is currently trading at $2.46 per share as of 7:55 a.m. ET on April 30th, 2026, marking an intraday decline of 2.37%. While the broader market often treats small-cap AI plays like speculative tickets, there is a massive gap between the narrative of a struggling penny stock and the actual numbers being reported from the company's London headquarters. Most people see a stock down nearly 70% from its yearly highs and assume the business is failing, but the reality is that the underlying revenue grew by over 500% in the second half of 2025. This creates a fascinating tension because the market is pricing RZLV as if it were a typical cash-burning startup, yet the company is guiding for $360 million in revenue this year and just exited 2025 with its first ever profitable month. The immediate pressure we are seeing in the market today stems from a mix of sector-wide tech exhaustion and the company's aggressive attempt to acquire Commerce.com. Investors typically hate uncertainty, and an activist push for a merger often leads to short-term volatility as the market weighs the cost of integration against the potential for scale. While companies like Apple stock or Nvidia stock dominate the headlines with their multi-trillion-dollar valuations, Rezolve AI is operating in the agentic commerce space, a niche that many retail investors haven't quite wrapped their heads around yet. They are building the plumbing that allows retailers to turn a mobile phone into a literal point of sale through instant engagement. If you look at your Robinhood app or your SoFi Invest dashboard, you might see the red bars today and think this is a sell-off, but the institutional volume suggests a different story. We are seeing millions of shares changing hands, which typically happens when large players are either exiting a position or quietly accumulating while the price is suppressed. One of the most interesting pieces of data that the general public is missing is the insider activity from earlier this month. While the price is hovering around the $2.50 mark, the CEO recently purchased hundreds of thousands of shares at $4 each. Think about that for a second. The person with the most internal information about the product roadmap and contract pipeline paid a significant premium over the current market price. When you see that kind of conviction, it challenges the common ground belief that the stock is headed towards zero. On investing sites and forums, the talk is all about the AI bubble, but Rezolve is one of the few names actually showing core software margins exceeding 90%. That is the kind of efficiency you see in established giants, not in small-cap companies that the market is ignoring. If you are using tools like Schwab Intelligent Portfolios or looking for investment help through a robo-advisor, Rezolve likely isn't on your radar because it doesn't fit the low volatility profile of an intelligent portfolio. However, for those who manage an individual brokerage account or use the Interactive Brokers platform, this is where the real price discovery happens. The stock has been pulled down by the recent OpenAI revenue misses, which has cooled the entire sector. But comparing a consumer-facing chatbot to a back-end commerce infrastructure provider is like comparing a movie theater to the company that builds the projectors. One depends on hype, the other depends on utility. Rezolve is deep in the infrastructure, and that is why they can process over 112 billion API calls for nearly 1,000 enterprise clients. Comment below how many shares of RZLV you currently hold, or if you're waiting for it to break back above $3 before jumping in. The daily swings in Rezolve are currently being dictated by the tension surrounding the Commerce.com board's rejection of their merger proposal. Rezolve has been very vocal about their poison pill tactics, calling the board incompetent for not seeing the value in a combined $700 million revenue entity. This is a classic David versus Goliath story, where the smaller, more agile AI player is trying to force a legacy commerce platform to modernize. For a trader sitting on a Fidelity trading platform or using Fidelity investments to track their long-term growth, this volatility can be nerve-wracking. But if you look at the 2026 guidance, the company is targeting a $500 million annual recurring revenue run rate by the end of the year. If they even get close to that, the current valuation will look like a rounding error in hindsight. Let's look at the actual business model for a moment to understand why the numbers are moving this way. Rezolve AI PLC operates what they call the Brain Suite. This isn't just another chat tool. It's a retail-specific large language model designed to have zero hallucinations. In the retail world, you can't have an AI guessing the price of a product or the shipping time. It has to be precise. They've integrated this into Microsoft Azure, putting them in the same room as OpenAI and Meta. This is a major credential that hasn't been reflected in the stock price yet. Most people are still focused on the AI label, but they should be looking at the commerce label. The revenue visibility for 2026 is actually quite high because a large portion of it is already contracted. When a company has over $230 million in contracted revenue and a market cap that isn't much higher than that, the risk-to-reward ratio starts to look very skewed. Institutional activity has been a bit of a mixed bag recently. We've seen some smaller funds trimming their tech exposure as interest rate fears linger, but the heavy lifting is being done by those who understand the shift from traditional search-based shopping to intent-based commerce. If you're checking your Fidelity mobile app or your Robinhood stock trading account, you might see that the stock is still trading below its 50-day moving average. Technical analysts would call this a bearish trend, but fundamental analysts would point to the cash reserves. With over $750 million in total funding secured, the company has stated they don't need to raise more equity to meet their 2026 goals. This is massive because dilution is the word that usually kills small-cap AI stocks. If RZLV is truly fully funded, then the floor on the stock might be much closer than the bears think. The macroeconomic pressure is the elephant in the room. The Nasdaq has been shaky as investors wait for the Magnificent Seven earnings reports. When giants like Nvidia or Apple show even a tiny bit of weakness, the smaller names get crushed because they are seen as risk-on assets. But this is exactly where the expectation versus reality gap lives. The expectation is that small AI companies will run out of cash before they become profitable. The reality for Rezolve is that they already had their first profitable month in December. If they can replicate that in the next earnings print, it could trigger a massive short squeeze because the sentiment is currently so negative. Looking forward, the catalysts are very clear. First, there is the May 14th board election for Commerce.com. If Rezolve manages to get their foot in the door there, it changes the scale of the company overnight. Second, the rollout of their brainpower models on Microsoft Foundry will start showing up in the partner revenue lines. Third, and perhaps most importantly, is the continued growth in their SDK reach. They are currently on nearly 60 million consumer devices. If you use a retail app or a banking app, there is a decent chance Rezolve is the technology power driving the personalized offers you see. When you sit back and look at your entire portfolio, whether it's filled with Fidelity ETFs, Fidelity mutual funds, or individual stocks on Robinhood Crypto, you have to ask where the next leg of growth is coming from. The big tech names have already had their massive runs. The real alpha is usually found in the companies that are actually solving a specific problem for other businesses. Rezolve is solving the problem of how a retailer competes with Amazon's data advantage. They are giving the little guys the same AI brain that the giants have. In summary, the market is currently looking at Rezolve through a lens of fear and sector-wide skepticism. The expectation is that the merger drama and the tech sell-off will keep the price suppressed. However, the reality of 90% software margins, a fully funded balance sheet, and a CEO buying shares at nearly double the current price suggests that the floor is being established. We are seeing a classic case of the market's voting machine being at odds with the weighing machine. The intraday movement today might look like a retreat, but when you zoom out and see the 500% revenue growth, the story becomes much more authoritative. Whether you are self-investing through a brokerage or following a more structured path through Fidelity Wealth Management, keeping an eye on the gap between reported revenue and market sentiment is how you stay ahead of the curve. The tension here is real, but if the 2026 guidance holds true, the reality of this company's scale will eventually force the market to reevaluate. Rezolve AI PLC started the day at $2.46, and while that number is what shows up on your screen, the underlying machinery is processing billions of transactions that suggest a much larger enterprise is being built under the radar. As we move deeper into the year, the focus will shift from these daily price swings to the actual execution of the $360 million revenue target. If they hit that, the narrative will shift from speculative AI play to core commerce infrastructure, and that is a transition that usually rewards the patient investor. Stay focused on the volume and the institutional footprints, as they often tell the story that the price action is trying to hide. Disclaimer, this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.